Broaden out the conversation with Dryden Pence. He's the Chief Investment Officer at Pence Capital Management. Seems like things really haven't been this outwardly bullish since we learned that the COVID stay-at-home economy was a massive boon to tech companies. Dryden, what do you think?
Well, I think that the outcome of everything here is we've reached that moment with the COVID boom. That was where I call it the three Fs, right? We had fiscal policy stimulation. And then we had Fed come in with, response to inflation, and everything became about what's the Fed going to do. And now, for the first time in 3 years, we're getting back to fundamentals. And fundamentals, as a result of COVID stimulation, as a result of the economy growing, of the fact that we've got more people working than ever before, fundamentals are now strengthening and are beginning to show up. And you're seeing it all across the market. You're certainly seeing in these big moves today. You're beginning to see profits that are really catching up. And so I think that now that we're moved into this environment for the first time in 3 years, fundamentals are mattering more than anything else. And I think that's why we see a resilient market. We see a market that's going to be moving forward, because in the end, it's all about earnings. In the end, it's all about earnings, and earnings are good.
I like that point. There's a lot of different ways stocks can go up, right? But they generally boil into one of two categories: valuation or the earnings. Multiply the valuation by the earnings, get the stock price. COVID was a lot of valuation with some earnings. Not much, though. Now it is a lot of earnings, some valuation too, but at least it's more balanced. Is this a more healthy style of rally we're experiencing?
Absolutely. I think it's a more healthy style of rally. And I think we're also going to see the fact, everybody talks about the Magnificent Seven, and we talk about chips, and we got all these things. But I think you're going to begin to see this broadening out of the improvements with all the other holdings of the S&P 500. Fundamentals are coming back. Earnings are going up. Corporate CEOs and CFOs can predict their profit margins because now they know their terminal interest rate. You got to remember, last year, nobody knew how high interest rates were going to go, so they couldn't predict their margins. Now they can. And so you're beginning to see all these earning beats come in. Inflation's coming back down. Margins are expanding, and people can actually begin to manage their businesses to maximize profit margins. And I think that we're going to see that throughout the rest of this year. I believe that the S&P 500 is going to have record earnings this year, and it's going to be more broad-based than it has been so far. If you think about half the S&P 500 is still 10% off of their highs, even though the S&P is at a high. So you've got a lot of opportunities in the rest of the market to find value.
One of the things we've been tracking in that conversation about broadening out market strength are the small caps. The Russell, which has been lagging, still technically in a bear market off of its all-time highs a couple of years ago. And every time it looks like the Russell's about to take off, it looks like it runs into this wall of interest rate-driven problems, where any moves in the yields higher seem to be bearing down still on these companies that have a lot of debt, that are unprofitable. Are we eventually going to break down that wall? How does that happen? What do you see there?
Well, again, it's very important. It's when do the rates stop rising? And we've had that. We're going to it's going to be a year of 550, right? Corporate managers are pretty bright in the United States. If they know what their interest rate is, they know what their cost of capital is, they can begin to manage around that effectively. What was really disruptive to the small cap companies was it's like everybody had an adjustable rate mortgage, right? You don't know how high interest rates are going to be, so you're not going to be very adventuresome in managing your inventory of anything else, right? If you don't know the interest rate 6 months from now and you have an adjustable rate mortgage on your house, are you going to go buy a new car? Of course not. So now everybody knows the terminal interest rate. We know that we've probably stopped at 550. It's only a matter of time before the Fed begins to lower, because they're going to have to, because inflation's coming down. And so now the next move for these people are lower interest rates and cheaper cost of capital. So I think that you're going to see across fundamentals, across companies in the rest of in the Russell and in the S&P, you're going to begin to see earnings firm up. You're going to see management be able to do a better job of going forward, because they can understand their risk, they understand their cost of capital, and that's going to turn into better margins for earnings. So we're constructive on the rest of this year. Again, it's getting back to all about fundamentals.
Okay, so it sounds like there is some dependency here on the assumption that, one, rates stop going up, Two, they eventually come down, provide some more financial flexibility to those in need. The AI stuff, the secular tech growth doesn't seem like it needs any help from rates. Are you a believer that investors should be piling into companies that are rallying 50% in a day or 100% in a month? Some of these big moves as we usher in what we've been told is this new era of tech. Do you see this as like an internet early days?
Well, I think that, again, you have to kind of look at what are the companies really doing. In the internet early days, you had a lot of companies that really had no earnings, that had no basis, that had really nothing to move forward on. Now what you're really looking at is a situation of companies being able to actually work through that and make money. And I think that that's the most important piece. So I don't think we're in this moving to a tech bubble. We're moving into a new tech revolution where you have data exploding and you have companies needing to meet that need and doing so successfully. So while I wouldn't pile into everything at a high, because I think that the market may be a little ahead of itself right now, but I do think that one has to really recognize that this isn't a non-earnings-led rally. This is an earnings-led rally, and the companies are making money. That's the key thing to pay attention to.
All right. Well said, well argued. Good conversation to fit the bull market today. Thank you, Dryden. Appreciate your commentary.
Absolutely. Thank you for having me, Oliver. Good to see you as always.
Likewise. Dryden Pence, Chief Investment Officer, Pence Capital Management.